Welcome to another episode of What's at Stake, a Penta podcast. I'm your host, Bryan DeAngelis, and I'm excited. This week we're doing, our first true crossover episode. So my co-host this week is Ylan Mui, the host of our Macrocast. Ylan, we're excited to do this crossover, but also going to tackle a pretty heavy topic, which is Basel III Endgame.
I love the name of this because it just reminds me of the Marvel Avengers series. It's not something that I would normally associate with banking regulation, but you got to have a little bit of fun when you're talking about a heavy topic. But I think this is a really good episode to have a crossover component because, we talk so much on the Macrocast about the Fed and monetary policy and where inflation needs to be, where employment should be, et cetera. But the Fed is also a banking regulator, a very important one. And so the role of the Fed in the banking system, I think, has become intensely scrutinized following the mini banking crisis that we had in the spring. And so I think that the role that the Fed is going to play in the future, especially now that we have Vice Chair of Supervision, Michael Barr, in place, is going to be really important to watch and could have impacts on monetary policy as well, as we see how banking regulation and the economy intersect.
And I'm really excited to do this one with you and having that Macrocast perspective because, to your point, in one way, it is sort of a niche financial services topic. This is the Fed, FDIC, OCC proposing capital requirements on banking institutions. And this is part of a global agreement. But the impact of this will trickle down all the way into, mortgages and small business lending. And it comes at a time where we've been talking a lot on What's at Stake about, is the economy starting to turn around? Are we hitting the soft landing? How are companies and others starting to pivot to think about all of their stakeholders as things start to ramp up again? So it'll be interesting to tackle this topic. And I'm going to steal from one of my favorite podcasts, Odd Lots, but I feel like we truly have the perfect guest to talk about this. We're going to interview, and I'm happy to welcome to the show right now, Greg Baer. Greg is the president and CEO of the Bank Policy Institute. Previously had served as the president of the Clearinghouse Association, as well as the EVP and general counsel of the Clearinghouse Payments Company. Greg's got a long history in financial services, managing director and head of regulatory policy at JPMorgan Chase, general counsel for corporate and regulatory law at JPMorgan Chase, not to mention deputy general counsel for corporate law at Bank of America, but also on the government side, assistant secretary for financial institutions at the U.S. Department of Treasury, senior counsel at the Board of Governors of the Federal Reserve System. So a ton of experience. I'm sure I left something out, but Greg, so happy to have you on the show to walk us through Basel III Endgame. Welcome to What's at Stake.
No, thanks so much. It's great to be here.
Why don't we just start at the beginning? So last week we got Basel III Endgame. Tell us what that means and what we saw roll out from the banking regulators last week.
Well, to think about Basel, it's really addressing four risks. It's credit risk, market risk, operational risk, which is basically cyber litigation risk, and then most technically credit risk as part of derivatives transactions. It was agreed to as an accord in Basel in 2017, so it's been now 6 years. But the U.S. regulators are have still been considering it and are now finally proposing it.
So walk us through. So this was the Fed, FDIC, OCC. They're proposing increased capital requirements on U.S. banks, but Basel is an international agreement. Tell us your first reaction. I know you guys feel strongly about this. What is the impact of this going to be on our economy?
In 2017, when it was negotiated, the widespread understanding and stated central banks who agreed to it was that it would not result in any increase in capital. They released a quantitative impact study showing the same thing. And the basic indication was that it would address a few outliers, which were not considered to be large U.S. banks, and would not disturb the availability of credit or liquidity in capital markets. So, and that's basically how it has been interpreted and implemented elsewhere. It's only in the U.S. where there have been substantial sort of upcharges with regard to the accord, basically around every aspect of it. And then, of course, also in the U.S., you're layering this accord on top of it for the GSIBs, a GSIB surcharge that's effectively twice the global standard and on a different methodology, and then a binding stress test that includes a capital charge. So you put that all together, and that's how you end up with the numbers that you're seeing, which is, according to the Fed, and we think that may be understated, on average, a 16% increase in capital requirements for everyone, somewhat higher for the larger banks. And, of course, the concern is, this follows sort of a real world test over the last 10, 15 years, where these banks really haven't had problems, particularly around the risks that we're talking about. You saw Silicon Valley Bank, but that was a concern around interest rate risk and deposit concentration risk, two things that this accord does not look at all. And the banks that are being subjected to this almost uniformly, or actually uniformly, did quite well during that episode. Some did extremely well. So it does seem like a non sequitur to any recent events and any past events.
I'm really glad you brought this up, and it was further down my question list, but I'm just going to ask it now. The timing of this is something I've struggled to wrap my head around. Like, I understand Barr and others at the Fed are going to point to SVB, but if I go back in time working for Senator Dodd with some of your colleagues during Dodd-Frank, they wrote this with an understanding that they would put in place stress tests to make sure the banks were well capitalized. And it's been 13 years, and I feel like the banks have survived every real and mock stress test out there that we could have ever imagined in 2008, right? We've got global pandemics. We've had slow growth. We've had the actual stress tests the Fed's put them through. Why is there such a push to do this now after all those proof points, and the banks have done so well through those tests?
Yeah, no, I'm glad you mentioned the stress test, just to say a word about that. It's done annual stress testing against the actual bank balance sheets, although it's a hypothetical scenario. And I think, this year showed once again, banks had 4 times as much capital as necessary to weather that test. And if you include long-term debt and preferred stock, which insulates taxpayers, it's 9 times the resilience you need for that. That amazingly is not mentioned anywhere in the 1,000-page proposal around Basel, nor is all the history that you cite. And the fact is, as you note, that banks operating in the United States, and that certainly includes foreign banks who provide a substantial amount of capital and are very hard hit by this proposal on both market risk and operational risk. They have all done very well, and they've done very well by the U.S. economy. It is very difficult to understand. And I think it's also fair to know, there usually isn't much dissension on things like this at the board or at the FDIC. And the fact that you saw 2 dissents each, and that included at the Fed, both Governor Bowman and Governor Waller, who is a career Fed economist. And then you also saw expressions of concern from the chairman. And then with regard to certain issues, Governor Cook and Governor Jefferson. So I do think that the sort of concern and confusion about why we're doing this is probably widespread.
Yeah, I agree. Ylan, let me, I'm hogging the mic here. Let me bring you in for a second. Jump in with any questions.
Yeah, I have so many questions, Greg, and I've always appreciated your clear and informative answers. One of the things that you said struck me, which was that, obviously Basel was a global accord. It wasn't just something that the U.S. decided to implement on its own. But you said that the U.S. is the only country that is imposing higher capital standards as a result of this. Can you sort of compare and contrast what's happening in the U.S. with what we're seeing in Europe and how banking regulators there are moving forward?
Sure. Well, the biggest contrast, and I don't want to get too far into the weeds here, but the whole notion of Basel, what we sometimes call Basel IV or whatever you want to call it, the 2017 Basel Accord, was to allow banks to continue to model credit risk subject to what's called an output floor. So basically, you can model the credit risk, but it can only go so low. And then there's a floor set by a government standardized model, and you can't be below 72%, 72.5% of what that model spits out. That was the whole point. That's what every other country has implemented. The U.S. is the only one that has said, no, we're not going to allow any further use of bank internal models, despite the fact that they have functioned great. And they, of course, the examiners for the banks, for the regulators, constantly monitor, backtest those models, and they've all done fine. But in the face of a Basel Accord whose whole purpose was to allow that to continue, and in the face of very good experience with it, the U.S. is throwing out what's called the advanced approaches or the internal ratings-based approach, and they're imposing effectively 100% floor. So that's pretty remarkable. And then, of course, they're doing that in conjunction with, again, a binding stress test that results in a capital charge, the G-SIB surcharge, everything else. And then on if you think about and they're also on operational risk, proposing a pretty significant deviation from what Europe and UK have done that would result in substantially higher charges on operational risk.
But maybe I'm preaching to the choir here, Greg. But isn't the whole point of having, a global summit where you reach a global agreement to have global standards for what regulations should look like? What does it mean for these multinational financial institutions when the regulations are so different in different countries when they were supposed to be harmonized? And that was the whole point, wasn't it?
Yes. To be fair, Basel always has this sort of escape clause that says this is the minimum standard. You can always do more. Although it reminds me of, you probably didn't ever watch The Three Stooges, but they had a scene where they would ask for volunteers, and two of the Stooges would take a step back, and poor I can't remember, it was Curly. I think it was Curly would end up standing there looking like he volunteered. So, if you're the only one moving up, then you really don't have global consistency. And I think you could talk about it as a matter of global competitiveness, but the truth is U.S. banks are actually doing very well around the world. I think the more important question is, are the costs of these capital charges higher than the benefits? And I think what's relevant from an experience around the world is they've all concluded, no, the costs for businesses, for consumers are high, and we don't want them to go any higher. And it's really the U.S. that is saying, no, we want them to go higher.
Do you have any concerns about the threshold at which these regulations would apply? You mentioned that the banks post SVB, the largest banks obviously did quite well. In fact, we saw deposits flow into the larger banks, but these new regulations would apply to banks with $100 billion in assets, which would capture some of those banks that were, kind of shaky during that spring turmoil.
Well, you sort of have to go bank by bank during the spring turmoil. The banks that were shaky were the ones with concentrated deposit sources and large unrealized losses. If you look at almost all the banks with 100 billion and up, their earnings releases the quarter after, of course, demonstrated that they had a diversified deposit base, both by geography and by industry. I think they would have done fine. I think the banks probably would have experienced the most trouble if there hadn't been a guarantee of uninsured deposits. We're probably a tick below that. And then it's also important to remember, Congress actually passed as a law, a statute, unlike Basel, which is not a statute, it's not a treaty, it's not an anything.
Right.
It's just it's an agreement by a bunch of central bank staff and maybe one principal. Congress passed a law that said tailoring for banks 100 to 250. And if you look at what the regulators released, not just the Basel proposal, but also AOCI and some other changes, they have effectively repealed that statute. There's basically nothing left. I think they have to do stress testing every other year instead of every year, but regardless, they're still subject to the same stress capital buffer. So they've effectively repealed a statute, which seems remarkable.
And maybe it's implied they've repealed it with little to no congressional input into this process. And I know this has been a point you and BPI have hit on a few times. There's seems to be a lot of lack of transparency and congressional involvement in the regulators' kind of decision and proposal here. I get the sense they fell pretty short on this from your perspective. Tell us more about kind of the engagement or lack of engagement that you guys saw on this front.
Well, I mean, obviously, nobody ever submitted the 2017 Basel Accord to Congress for ratification. And I don't think there were even any, and maybe that's on Congress, but maybe there were no hearings on it. And so, this is the first attempt for ability for people to look at it. One other oddity, which I think was discovered more lately, is, they were actually doing a quantitative impact study during the comment period, but apparently they have no intention of seeking comment on it. They're just going to announce that and be done with it, which is kind of backwards from the ABA perspective. I don't know if you want to get to it, but I mean, I think that the even greater APA transparency concern is around the stress test, where they don't have any intention, apparently, of ever putting it out for notice of comment, even though it now, since 2020, has yielded a binding capital charge. And that's the one that's very difficult to understand as both a legal and a policy matter.
How engaged do you see Congress getting in this? I mean, I have to imagine it's not sitting well with a lot of members who were involved in both 2017, but even seeing some of the impact this could have in the economy. I know Senator Tillis and others have voiced some concerns. Do you expect Congress to really kind of hold these regulators, with their oversight jurisdiction, like, to task for what they're pushing forward here?
Well, I mean, if you judge by the first week reaction, yes. I mean, I think there's been a very large reaction on the Hill, sort of unprecedented with regard to a pretty technical capital proposal. And it's bipartisan. I mean, there are concerns around, Basel and transparency in general, just sort of as a supranational organization. I think there are a lot of concerns about economic growth and GDP, because there are absolute trade-offs there. There are concerns about effects on low and moderate income people, with some of the upcharges on consumer and particularly mortgage. And then there's a whole group of members, including a lot of Democrats, who voted for 2155 and want to know why the agencies have repealed it without seeking their input on that.
But Greg, how do you respond to the regulators' argument that, most of the banks that would be affected by this already have enough capital to cover these requirements? And that, there's going to be a lengthy transition period of 3 years. So, you're not even going to really see these take full effect until the second half of 2028, which is over a decade after the Basel Accord was actually agreed to. So, the regulator's argument here is, we're giving you plenty of time to adjust to these, and a lot of banks may not even be very much affected at all.
Now, I'm really glad you asked that question. First, and probably most importantly, whenever this takes effect, there's going to be a permanent reduction in GDP, jobs, et cetera. So it doesn't matter whether that's 1 year from now or 3 years from now. From then until the end of time or until it's repealed, you'll see a reduction. I think the Basel rule of thumb is 100 basis point increase in capital, 16 basis point decrease in GDP. But that's just sort of at the larger level. What's really important is banks optimize their capital. And it's important to realize what that means. And you already heard, if you listen to earnings reports this quarter, they're already talking about how they're going to do balance sheet optimization or risk-weighted asset optimization. And what that really means is we're going to make sure that we don't have to raise capital, because we're going to lower our assets. A capital ratio is a ratio, right? The numerator is capital. The denominator is assets. And so if you can figure out, which you can, what are the assets that are yielding the largest capital charge by inflating the denominator, you're going to get rid of those assets. And they're going to do that now, right? I mean, so basically, if I told you you're thinking about buying an electric car and we're going to outlaw charging stations in 3 years, you wouldn't keep buying electric cars up until 3 years from now. You would say, I'm getting out of this business right now. And so if you tell banks who actually think about their businesses in terms of return on capital, and I'll get to that in a second, oh, in 3 years, there's going to be a huge change. Well, you will not continue to reinvest in that business. So anyone who thinks that the effects of this are going to be delayed meaningfully just doesn't understand how business works, how banks work. I mean, the only benefit is, yes, you're not going to have to go out and do an immediate capital raise. But certainly you're going to begin doing business planning on this assumption, and your investors and your analysts are going to assume that you're going to do that as well, and they're going to insist upon that.
So when we think about the types of assets that banks would then be looking to shed, I mean, that goes to the question of access and equity, doesn't it?
Yeah, I mean, it's sort of across the board. I mean, again, with all the major risks, I mean, I think for a very few banks, but to a very large extent for those banks, the largest impact is on trading and the ability to continue, making markets and securities, which would have major business impacts. And then from there on, it's sort of business by business. I mean, the second largest impact is on banks that make money basically based on fee income primarily. So that would include credit card banks, custody banks, payment services banks, investment banking. Those businesses are very hard hit by the operational risk charges here, because for really an irrational, on no rational basis, the proposal distinguishes based on whether you get your income from interest income or fee income. And despite the fact that the regulators have for years, and then on credit, I mean, generally Basel, because it has a little more granularity around credit and lets you differentiate, better loans from less good loans, is generally better. Regulators significantly deviated from the 2017 accord and basically added upcharges with regard to mortgage and consumer. So there, it's still going to be a little better, but it's not as good as it could or should have been.
And that's kind of what I was trying to get to, Greg, is that, we've seen some outcry from groups that you may not normally think of as weighing in on banking regulatory policy, or maybe even groups that you wouldn't necessarily consider on the side of maybe working on improving these regulations. And that is groups like the NAACP, the National Urban League, the National Housing Conference. I mean, they're raising concerns that it's possible these new regulations could, sort of have a backlash, an unintended consequence of reducing access to credit and to mortgages for low income and underserved communities.
No, I think that's exactly right. And I think it's really encouraging that folks actually are focusing on this. It's always been difficult because people think of this as, higher taxes, higher capital surcharges on banks. And, nobody really likes banks much. But it's really a matter of convincing the end users of these products that you're going to see reduced credit availability and you're going to see higher prices. That's always sort of been the holy grail, I think, for the banking industry when it comes to responding to proposals like this. And I think you've seen it. I think you're going to see a lot more of it because, maybe it's, we've done a better job this time explaining it. Maybe it's so bad that you can't ignore it anymore. But I think you're going to see across a whole wide range of businesses, the end users, which is for credit is really consumers and small businesses, coming forward and saying, wait, why do we have to pay more for loans when this has been working really, really well for the last 15 years?
Maybe one final question and kind of a follow-up to what Ylan was just asking. I'm still stuck on this idea of the timing of this and why now. And we are, in my view, we're coming out of a tough economic time with COVID and a long season of rate hikes. I think the Fed's going to nail the soft landing, but this feels like it has the potential to be a bit of a body blow to the economy and kind of throw some of that off. It also strikes me that we're into an election year and, Biden's running on the economy. Moderate Democrats in tough states are going to be running on the economy. This might not be kind of the, again, body blow that they want right now in the middle of this. What are your views on all that?
Well, yeah, I would say, there's really never a good time to, raise capital spuriously and for no particularly good reason. Because again, the effects of that are longstanding. So, I don't want to be hypocritical. I'm not sure if you asked me if there was ever a good time to do this. Maybe if we were booming, but even if we were booming, you would say, well, we could be booming a little more. It's really important, I think, to think about this in terms of the long term. And the fact that this is a permanent tax on growth and jobs. And the question is, are you willing to pay that tax? Now, back in 2010, we were, because we just had a global financial crisis. And what we've seen is, since then, capital at the larger banks has more than doubled. Liquidity's gone up substantially. More things, off balance sheet exposures that were brought on balance sheet. Capital is now real capital, not there used to be hybrid forms of capital. We've seen, sort of a revolution in modeling of risks, again, using the advanced approaches, which has been quite successful, and the examiners have all, sort of monitored and back tested. And so, the real question is, why are we folding a winning hand? In terms of the timing, I think, part of this is just, other nations have proposed Basel and to implement Basel. And there is a lot of peer pressure on U.S. regulators that, yes, you need to do it too. And if they don't, well, then, there's a concern that some countries will abandon Basel and go lower, and that would not be a good thing. But none of that is to say that the U.S. needs to propose a version of Basel with substantial upcharges, really pretty much across the board.
Ylan, anything else on your end?
Greg, one thing you said earlier was that, once the regulations go into place, they'll be there permanently until and unless they're repealed. What do you think are the chances of that happening?
Well, I think I would count on you guys for the electoral forecast. But, again, that this won't take effect for a while. And perhaps the greatest impact of that may be that it gives a future greater group of regulators the chance to revisit it. Not to mention the potential for a future group of legislators to revisit it. I don't think we're shy about the fact that if this goes through as proposed, we aren't going to stop. I was talking to another bank CEO yesterday who was just absolutely mortified. He just couldn't believe what they have done. And he talked about the history, and he talked about, they all told us in 2017, this was not going to be a capital increase. And, I think you guys know, if there's one thing people in finance can't stand, it's retraders. It's the worst thing you could say about somebody is, right, he's a retrader. And this is the biggest retrade ever. And no one understands why it's being done.
I think with that, that's a good point to leave it there. Greg, we really appreciate you coming on and shedding some more light about what's going on here, and more to come for sure as this plays out over the next 100 days, if not longer. But we appreciate your insights and hope to have you back on again soon.
No, it's been a real pleasure. Always happy to talk about capital anytime, anyplace.
As we said at the beginning, that was our first crossover episode. So for more episodes of What's at Stake or the Macrocast, subscribe to our Penta podcast channel wherever you get your podcasts. You can also find us on X, formerly known as Twitter, at PentaGRP, or on our website at pentagroup.co. I'm Bryan DeAngelis, here with my co-host, Ylan Mui. Thank you for listening to What's at Stake. We'll see you again next week.